Hi, I'm Peter Rose, founder of Longwood Currency Trading. Getting out of a bad trade is tough. Exiting a bad trade is really difficult. It's difficult from a psychological standpoint, and so that's why we have stuff called stop losses. And generally those are applied at entry. I mean, that's the characteristic of the stop loss deal. But what happens when you get into position management and you've moved that stop to a certain degree, or maybe you're not doing a stop? There's certain times when you trade and you don't use stops. If you're doing multiple trades, you're doing quick action stuff, not even scalping, but you're just needing to be very flexible in your thought process during a trade. You don't want to be having restrictive elements like limit orders to take new transactions into the position, and you don't want stops out there clouding your view of what price action is actually doing. I have to get Bo out here. It just got done raining pretty hard, and so I told Sue, look, I'll take him out for a walk in the woods before it starts raining again. So I'll probably be out here in the woods and we're going to get soaked. But I'll have to keep calling him because he doesn't want to be in the rain. Come on. Hey, come on. Come on, come on, come on. Yes, we have guidelines when you're starting out in trading, very strict guidelines that need to be followed. They're not open to interpretation. You put a trade on and boom, right away you're going to have to put your stop up there, because you have to be trained to learn entry analysis. And if you're not successful at your entries, it means that you're getting stopped out. When you get stopped out, you go, oh damn, what did I do wrong? But if you don't set that stop in the beginning stages of your activity, how are you going to know where your errors are? How do you know when they occur? If you just let that sumbitch run for 20 minutes and there's no stop involved and the price is bouncing all over the place and then you get porked out, how are you going to know what happened? One of the important criteria that you need to know in your trading is when you have a position triggered and it gets stopped out, how long did it take to get stopped out? Generally, if that's going to happen, it's going to happen right away. And that's really nice, because if it's going to move against you that much, whatever your stop is, whether that's 8 pips or 20 pips or whatever you want it to be, at least you say, if this trade pukes on me in the first 8 minutes, 15 seconds, 2 hours, whatever time frame you're on where you're judging this stuff, then I know that that's my danger zone for my ability level, for my metrics and stuff. That, you know, if I make an entry decision and it's constantly getting banged out in 20 seconds or 2 or 3 or 4 or 5 minutes of the trade being put on, then you know that your entry analysis is wrong. If you put your trade on and it floats around for a while and it doesn't do anything, and then it stops out, then you know that your stop's either too far away or you're misjudging the viability of your opening move, your entry, right? So that's one scenario. Those are good actions. Those don't necessarily make them bad trades. They could be good trades, they just didn't work out. Or they could be stupid mistakes, bad trades. That helps you learn. But when you get more experienced, if you're going to do a set and forget, then you need to do your stops. But if you're going to sit there and you're trying to get the resolution to your trading done in 2 hours, you can't do set and forget, because there may be an opportunity for you to get in and get out and get in and get out and do that 3 or 4 times before you get the trade that's going to do the work for you and run. Because if you get stopped a couple of times in a row and your timing is off, let's say you're trying to break out of a zone, a channel or something, and it breaks and it fades back on you, and then it breaks again and it fades back on you. Well, there's an indication there that somebody wants to break through that particular resistance point. And so you may be going in that following time. So set and forget really doesn't work. You have to be there managing the trade the entire time. By bad trade, in my opening comments here, I meant that the price moved against you, and it's just moving against you, and you're in negative territory. Could be entry level. It could be that you have built your position and price was going along fine. You haven't set a stop. The thing turns around and goes against you, and it's like maybe, or you might have just not even gone in with an initial stop because you're managing that trade, and it's going and it's going, and things are looking good, and so you don't want to be encumbered by that stop, even the following a trailing stop. And so there you are. You're floating naked in the pool, and the thing turns against you. That's not a bad trade. It wasn't bad because you made a bad decision. It's just not going good for you. And so that's what I meant by getting out of a bad trade is very difficult. A bad trade can have those two connotations. One, you made a mistake and it's bad, and you need to stop to get out of that. But if you have a position that you're managing and it goes bad on you, that doesn't mean that you did something bad. It means that price didn't do what you thought it was going to do, or it's doing what you think it's going to do, which is maybe a minor regression to some mean level on a lower time frame, which doesn't count on the larger scale of things, but it's still costing you a lot of money. I was calling for the dog again because it's starting to rain. He's gone. That's a bad trade. We're not doing anything wrong. We're just in the wrong place at the wrong time. Those are the trades that are very difficult to get out of because all the characteristics of your entry analysis were proved correctly. You got the trade going. It's moving in the direction you need it to. Your position management for building on the lots or staging into the position as it's gone through, that's all been working out. And now all of a sudden some bitch has turned around and you're in a negative territory. And you're saying, oh man, I'm down a couple of $1,000 or something like that. And, we're not trading minis out here. I work with 5-figure account holders and above that aren't having the success that they think they're having. So that's the person I'm trying to work with. If you're just getting into this and you're dealing with trading mini lots, or you're trading 1 or 2 full lots or something like that, then a lot of this stuff won't make any sense to you right now because you haven't experienced it. There's the dog. Hi, Bo. But you still need to be aware that this is coming up. You don't try to replicate this stuff because you're not ready for that. If you're trading three full lots, you're not ready for this stuff. You got to be trading 8, 10 lots before you get into this kind of problem. Because you ought to be all in, all out, learning your metrics and learning how to do good trade entry analysis and all the rest of this stuff that I try to work with you on. But when you get up to trading to the point where you're in that 8 to 10 or whatever, and right now I've got a trade on for 16 lots. So when you get up in there, you've splattered that position out over multiple transactions at different points for different reasons. And each time you add that transaction on there, you're doing more entry analysis. And it becomes a little bit more involved than just picking points out of the air and saying, oh, I think I'll drop another couple of lots in here. And that's where a lot of my work with folks comes into play, is how do you balance breaking that bank up into different lot sizes where you're staging them in, because each time you stage a position in, it raises the average position value, and therefore your original profit target is not fully realizing the net profit that you wanted it to, because you've added a lot closer to that, brought the average price up, and even though that lot that you put in, those lots that you put in, add to your overall profits, the rest of the position suffers because of that average position to a degree. If you do the math on it, you'll see what I mean. So all this stuff is very delicate, and you have all this stuff going on in your head as you're managing this stuff. And so when it goes against you, you go, oh, wait a minute, I've been sitting here for 15 minutes putting this shit together, and it's boiling over now. So you can't turn the heat down because FIFO rules in the United States, you can't just peel off your upper lots. You can't reduce the size, because then you bring the average position up even closer to your current price, and that just makes things worse. I mean, it's really a difficult thing. The trade is treating you very badly, and for that reason, it's very difficult to cut loose from it. You can't. You just go, I'm $4,000 down. What am I going to do? Well, you have to have some rules to mitigate that situation, because you don't want to get into a position where you're not floating a stop. It's a trailer, and you can't in situations like this. That's not trading. Putting fucking stops in there is not trading. But when you end up with a $4,000 loss, might only be 8 pips, but it's $4,000. So how do you balance? You've got to know your metrics. Is 8 pips a lot to be down negative in this particular kind of situation? Well, maybe not. But the dollar value of the position may be grabbing your nuts and squeezing them to death, right? And so what are you going to do in that scenario? You've got a pip position that's okay from the planning standpoint of trading, but you've got a dollar value that's now a greater percentage than you'd like to lose on a particular trade. And even if you had a couple $100,000 in your account, and you're going to take a $4,000 hit just because the price is floating against you a little bit, that's troubling. And so, what are you going to do? You're going to cut that short when it runs 2 pips against you. So now you're losing $500 or $800 or whatever it is. You won't do that, because the pip balance or imbalance isn't there to cause a situation where that would be something that you'd want to do from a trading standpoint. And yet at the same point, you're looking forward and saying, if this thing moves 5 more pips against me, it's going to go another $3,500 against me, because I'm carrying too much heat. And there's the reason that it's very difficult to cut loose of a bad trade. It's because it's a lot of dollar value. Yes, you can't trade your PL, and you can't trade based on dollars in the beginning. But when you're trading with a lot of heat, you have to consider the dollars, because don't forget, 5 pips on a 10 lot is $500. So it's 5 pips. So you have to get out of that mentality of, oh, I'm going to trade for 10 pips and I'm going to, I'll put a 10 pip stop and I'm 1-1 and I'm winning more than I'm losing, and so in the end run I'm going to be okay. That stuff goes out the window, because now your emotions are involved in seeing a $4,000 loss as opposed to, oh, it's just 8 pips. There's conflict there. And so what I've been able to do is I resolve that conflict with a couple of rules that say they have to do with the analysis that I did when I put that next lot on. If that next lot size load, if the position then goes against me, what's the dollar pain to that? And if that dollar pain is too great for a small pip change, I can't put that on. I can't put that on because I can't put myself in a position where I don't have a floating stop behind this runner, and I'm not going to be able to emotionally work through, no matter who you are, and say, oh man, that's a $4,000 hit. I'll just let that run because it's a regression to the mean event, and I'm going to bounce off to 55 and it'll come back. Because then you're on the hour chart, and then because if it doesn't, then you're going to go to the 4 hour, and then what the fuck are you going to do? Go up to the daily, and now you're $12,000 out, and you're going da-da-da-da-da-da. It's highly problematic that you'll be able to shake free of. Now, sometimes I've let positions like that run, and they've gone 10, 12, 15,000 against me. But in relationship to the size of the bank I have and where my overall position has been placed in expectation of a certain outcome based on probabilistic analysis, then when that price does turn around, I can load more lots into it and really get a good bang for that particular run. The problem is, if you have to do a carry overnight with that trade, it usually doesn't work out in your favor. So if you're not going to be able to close the trade during the day, then you probably shouldn't be stacking so much shit into that trade that your average position value would cause a small reduction in the wherever the price is, 10 or 15 pips or whatever it is, to clean you out. You'd want to be 30 or 40 pips away from your average price value when that price starts to turn against you, so that you could go out 20 pips and say, oh, I've lost $8,000 of my profit. I'm going to get out now and preserve the $4,000 gain that I had. And I'll bet you a dime to a donut that $4,000 gain will be a good percentage of the overall risk that you're taking, so that your return against that trade, even though you lost technically the phantom $8,000 gain, you still got $4,000 out of it. That's the solution that I use anyway, in order to trick my brain into saying, this is such a tough trade to get out of because I'm 4,000 behind, and you know, you get nervous about that because you realize that you don't have a lot of room for that price to move before that kind of situation happens. If you do the construction of your position correctly, you aren't faced with those kinds of problems. And it took me a long time to realize that, and it's difficult to implement as simple as I can show someone else, because I've got 40 years of real estate investment that contradicts the process that I'm talking to you about implementing. And so for somebody who studies with me and takes consulting with me, and I show them these rules, they go, oh yeah, we could do that. Why can't you? Well, you don't have 40 years of real estate against you. So just be aware that a bad trade, in the definition that I'm calling it on here, is very difficult for you to get out of. In fact, you won't be able to get out of it unless you have compensating rules that create an environment where it's not a psychological hit as well as a financial hit. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.